remember that I called on Patrick last week to find us a real heavyweight interest rate expert to help us navigate the developing situation in Treasury yields and the U.S. dollar. And boy, did he deliver. Wall Street legend Jim Grant, founder and publisher of Grant's Interest Rate Observer, will join me as today's feature interview guest. We'll discuss everything from Treasury yields to the dollar to inflation to gold and even junk bonds. Be sure to stay tuned for our post-game segment after the feature interview, when Patrick and I will build on some of Jim Grant's economic outlook and look at charts and graphs for specific ETFs and tradable instruments that relate to the various trends that we see developing in fixed income markets as well as elsewhere.
And I'm Patrick Sresna. Now, Eric, the S&P 500 really has just been hovering here. It doesn't really seem to get any traction to the upside. I think we're about 2740 as the time we're recording. What's your thinking here on the markets?
Well, it looked like it was rolling over in the short term, and I thought that we were headed down. It seems right now that the market is rallying late Thursday afternoon on news that President Trump will exempt two countries, Mexico and Canada, and is only declaring a trade war against the other 206 countries on the face of the earth. That's good news at the moment, I think, because of the Canada exemption. I wouldn't be surprised if that wears off as the message really sinks in that we are still talking about an announcement that is fundamentally about imposing tariffs on imports of steel and other commodities. And I don't think this is a good story for the market. But right now, the exemption, the carve out, as it's been called, for Canada particularly, and also Mexico, seems to be pushing a bump higher. I wouldn't be surprised if it doesn't last. I do think that for the most part, the top of the bounce is in. I expect that we'll see below 2,500 on the S&P before we see higher than 2,800. Now, that doesn't mean that I don't expect to eventually see higher than 2,800. I am still favoring the scenario that this is a market correction that is not the beginning of the end, so to speak. I think that market correction, once it plays out, may still lead to higher all-time highs. On the other hand, it certainly is possible that we're at the beginning of a new bear market. It bears watching carefully. But for the moment, Patrick, my expectation is that we're going to retest the lows, maybe a little bit of a lower low, somewhere in the 2,400 to 2,500 range, and we'll see how things develop after that.
All right, well, let's move on to that U.S. dollar index, because while everyone's focused on Trump and these tariffs, it looks like it was Mario Draghi and his a little bit more hawkish stance that seemed to have turned down the euro and pushed the U.S. dollar higher here. What's your thinking here on the dollar?
Well, as far as I'm concerned, Patrick, this chart is still indeterminate on the dollar index. As you know, Juliet de Klerk has my utmost respect. She's been saying, hey, when we hit 121 and whatever it was on the dollar euro, that was buy the euro, sell the dollar there, and we're headed much, much higher on the euro, lower on the dollar. A lot of people, though, thought that when we broke 123, which was kind of a key technical level on the euro, that it was really going to accelerate from there. And in fact, it looks like we kind of had a false breakout, and it's rolled back over now. If I look at the chart, Patrick, to me, we've had a higher high now. We have not yet had a lower low. So I think where this next short-term low comes in on the chart is really going to tell us what's next. I don't think that we have a determinate pattern yet. I'll certainly ask Jim Grant, but as far as I'm concerned, the jury is still out, and I'm honestly very much conflicted because in my own analysis, as I look at this, I'm not sure, but I lean a little bit more towards a dollar bullish view. At the same time, I have a huge amount of respect for Juliet de Klerk. She tells me that she is still recommending a dollar bearish view. So we'll see what happens.
All right, well, let's move on to crude oil because it seems to be weakening since that inventory number. You got to tell me what's happening here. We're almost down at the 60 level here. What's your thinking?
Well, my view is and has been that what should happen is West Texas Intermediate should continue to move down over the next several weeks and eventually get to, let's say, at least a $50 to $55 price target in coming weeks. And that could be considerably lower if there were a speculative unwind where everybody is panicking and selling out, where so much positioning is all on one side of the boat, with more than $1 billion still of speculative longs in the oil market between both Brent and WTI combined. There are several caveats, though, to my bearish view. This market has shown us just amazing amount of resilience. It seems to want to shrug off bad news and really embrace good news. The other thing is that if Juliet is right about the US dollar, and we're about to see the dollar really move further down, that's got to be oil bullish. So far, what we're seeing has been consistent with my expectations, but it's been delayed. I thought we were moving down sooner, and I didn't think it was going to take this long, and I thought we would already be lower by now. I could be proven wrong again, but what we've seen in the last couple of days are some really strong technical indicators, closes well below all of the short-term moving averages, daily and weekly stochastics turning negative on not just WTI, but the other energy contracts, whether it be heating oil, gasoline, and so forth. So we're really seeing a lot. I have said before, it's really going to be in the fundamentals that drives this. What we got this week was very interesting action around inventory. API, that's American Petroleum Institute, the private service that forecasts inventory on Tuesday afternoons, they said they expected almost a 6 million barrel build on national crude oil inventory. So when the actual EIA number came in at 2.4 million barrels build, now that's still a pretty significant build, but it is so much smaller than what had been anticipated by EIA. The market took that initially as a very bullish sign, with crude oil prices moving dramatically higher just as the news came out. Cushing, Oklahoma drew down 605,000 barrels. That's still a pretty hefty drawdown for Cushing, Oklahoma, but compared to the 2 million barrel plus weekly drawdown figures that have become commonplace in the last several weeks, this is a little more than 500,000 barrels drawdown. It's not nearly as bad as it's been. Gasoline drawing down 788,000 barrels, much, much smaller than API had expected of a much larger gasoline drawdown. Distillates drawing down 559,000 barrels. Now, production was up 86,000 barrels. That should be bearish for oil prices. I think the market didn't notice that right away because prices did go shooting to the upside on inventory news. But you know what? It only lasted for about 30 minutes or so. We did not get higher than the previous day's high price. And sure enough, about a half an hour after inventory was in, just as I was beginning to tape our interview with Jim Grant, holy cow, the bottom fell out. We were down $2 on crude oil prices in the matter of just a few minutes. And I think this is the sign of more to come. I think that we finally broke out of an indecisive, indeterminate status in the market, but it's going to depend, again, on what we see in the fundamental data from EIA. If we get big drawdowns in crude oil inventory next week, then that will change everything. Right now, though, what we're seeing is pretty significant. Keep in mind, we also had 1.5 million barrels per day of exports. That translates to 10.5 million barrels on the week. So if you were to go back to the previous regime where it was illegal to export oil, that 2.4 million barrel build on inventory might have been 12 point something million barrels. I think that we're going to finally be able to say that the downtrend has thoroughly locked in, but I will qualify that to say there was a key technical level right around 59.96 or so that we need to close below, and we were just below it about 30 seconds before the close today on Thursday, and we bounced up above it, Patrick. So we still need to get down to a solid 59 handle before I really feel like the downtrend is locked in, but at this point, I think we're headed lower in price. And again, if that speculative unwind were to occur in a panic type of situation, we could easily get into the mid-40s or even lower. I think that would be short-lived, and we'd eventually stabilize around $50 or so.
All right, well, let's move on to gold, because as soon as the U.S. dollar had a little bit of a pop this morning, we see gold coming right off of the top end of the range back to about 1321. What's your thinking here on gold?
Well, it goes all back to the dollar. I think that what you can say is gold is performing in strong inverse correlation to the U.S. dollar. The scenario of both of them moving together that we've talked about with different guests in the past is not happening. So you've really got to have a strong view on where the dollar is headed before it makes any sense to have a strong short-term view on where gold is headed. And I don't have that yet. We'll see what happens. As I said before, Patrick, I think that the dollar chart in my eye is still indeterminate. As I mentioned, Juliette de Klerk is no slouch. She has said it's time to buy gold here, so that's certainly one indication in one direction. I'm definitely going to ask Jim Grant about this. He is very well known as a big fan of gold, so I'm sure he'll have plenty to say about it as well.
And finally, Eric, what's your thinking on Treasury yields?
Well, I want to save the bulk of that for Jim Grant because obviously this is his specialty, and I can't hold a torch to Jim Grant when it comes to interest rates. He is the man. What I'm going to do is use this time for a different purpose, which is just to kind of go to the big picture of where we're headed with Macro Voices in the next several months. You know, as a pilot and sailor, Patrick, people sometimes ask me, you must know a lot about weather. How do you tell when the weather's going to change? Do you look for a certain pattern in the sky or what is it? And most people would never guess. It's actually a change in wind direction is the telltale sign that always means the weather is going to change, especially if there's an abrupt change in wind direction. And the reason I invoke that analogy right now, I think in the grand scheme of history, if we look back 5 years from now on the last 6 to 12 months, as we've seen a 50 basis point backing up of Treasury yields from 2.35 up to 2.85, that 50 basis points, some people made money on it, some people lost money on it. It won't matter in the end. Nobody will care. It will be forgotten. On the other hand, I think the end of 2017 coming into the beginning of 2018 will probably be remembered for a long time as when the wind changed. Now, when the wind changes, it doesn't necessarily mean bad weather is coming. It might mean that the weather is improving, but it always means the weather is going to change. And my own talent, I would say, I don't claim to know all the answers. It's one of the reasons we produce this podcast. I am much better at knowing what the important question to focus on is than knowing the answer myself. And I'll tell you, Patrick, if you want me to make a bold statement in terms of my own predictions, interest rates, particularly what's going on with the treasuries, what's driving it, and where are we headed? How far can it go before something breaks? That's topic number one. Topic number two that's going to be critically important is the U.S. dollar. Are we really in a secular downtrend, or is this going to reverse? Topic number three is inflation or deflation. Are we about to see a resurgence of inflation or not? Those are the key questions. I am absolutely convinced. And I think even, if you're primarily a stock investor, still, those are the things you want to focus on because of the signals that they will tell us about the macroeconomy and where markets, including equities, are headed. So what we're going to try to do is focus on getting as many really solid experts in these areas. Interest rates, number one. That's why we've got Jim Grant for you this week. We're going to focus on getting inflation experts, dollar and currency experts, and we're going to try to focus on those areas. So that's what you can look forward to. And I'm not going to try to tell you this week what's going on with Treasury yields. Let's save that for the expert.
Well, thanks for the summary, Eric. Now, this week's featured interview guest is Jim Grant, editor of the Grant's Interest Rate Observer. Eric's interview with Jim is coming up as Macro Voices continues right here at macrovoices.com.
And now with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me next on the program is Jim Grant, famously the editor of Grant's Interest Rate Observer, one of the best-known publications on Wall Street. Jim, I have so much been looking forward ever since we launched this podcast 2 years ago with Jim Rogers, actually, as our first guest. I've been looking forward to getting you on the program, and frankly, I'm glad it took this long because I don't think there's ever been a more important time in the last 10 years to be very closely observing interest rates. Before we get to interest rates, though, I want to start with a higher-level question. New Fed Chair Jay Powell running the show. What is your expectation? Is Jay Powell a good pick to replace Janet Yellen? Do you think that we're going to see a change in policy from the Powell Fed as opposed to the Yellen Fed? And what's your overall reaction to the state of the Fed, so to speak?
All right. Well, Jay Powell has one commanding credential, and that credential is the absence of a PhD in economics on his resume. I say this because we have been under the thumb of the doctors of economics who have conducted a policy of kind of academic improv. They have set rates according to models which have been all too fallible. They lack historical knowledge, and indeed They lack the humility that comes from having been in markets and having been knocked around by Mr. Market, who is a very tough hombre. Jay Powell, at least, has worked in private equity. He knows a little bit about the business of buying low and selling high. So I think it's also he's an English speaker, a native English speaker. If you listen to him, he speaks in everyday colloquial American English, unlike some of his predecessors. So I'm hopeful, but not so hopeful as to expect a radical departure from the policies we have seen.
Let's go ahead and carry that forward to Treasury yields then, because obviously this is the topic on everybody's mind. We've seen this backing up in rates, and there's every imaginable theory from this means inflation coming to this is a reflection of Powell being more hawkish and it's all about Powell to this is about President Trump's policies and deficit spending. What do you think is driving this backing up of interest rates, and where do you see it going from here?
Eric, I'm a little bit more fatalistic. We have come to accept that financial markets are driven by people and policies and by personalities. What is Chairman Powell going to do? What will President Trump tweet next? As if they were in charge. Well, perhaps sometimes they are not in charge. I observe over the years that the bond markets have tended to move in generation-length cycles, anywhere from 20 years to 35 years. This is not an iron law of physics, but it is an observation from the middle of the 19th century forward. So we have concluded perhaps the bull market in bonds that began in 1981 and that maybe ended in the early days of July 2016, I think. So it might just be that interest rates are going up because they are going up. It sounds a little bit mysterious and indeed fatalistic, but I'm a little bit less inclined than others to assign causation to people and policies.
Now, last time that we were at a secular low in yields, that was in the 1940s, and it took a full decade.
I remember it very well, Eric. I was there. Well, I was there. I was born in July of 1946, so I missed the first 3 months of the bear market, but my mother told me about it. She said it was fabulous.
But it took, even though you were born only 3 months into that, it took 10 years before there was a meaningful rise in interest rates. Does that mean that it's going to take 10 years before we see a meaningful rise, or is the meaningful rise already upon us? And how far can it go? What stops it? What breaks if things get too far?
1946 to 56, 10 years, rates went up about 10 basis points a year, 1/10 of a percentage point a year. Very, very slow, deliberate. Now, I think, and not no, mind you, I think the tempo will be, I think, rather more brisk. I say this because there's more leverage in the system, because there's more debt around, although one could argue that the debt is going to constitute a damper on things. I happen to think that the debt will, in fact, become a problem that will lead to higher rates. That is another guess rather than a piece of knowledge. So I'm looking for a bear market in bonds having begun in July of 2016. I think it's upon us, and I think the tempo will be brisk enough to notice.
Jim, you were on the cable networks last week and mentioned that the timetable could probably be different because risk parity might speed things up. What's the mechanism of operation there? How does it come into play? And I guess the other part of the question is, what would be the limit how far this can go? Some people have said rates can only go so far before the stock market crashes or something. Do you think there's a limit as to how far rates can back up, and what would that limit be?
Well, first, as to risk parity, as you know, is based upon the proposition that bonds are inherently less risk-fraught and less volatile than equities. To someone who's around in the 60s and 70s and 80s, that proposition is somewhat contestable. But that's the idea. So if stocks are inherently riskier, what you want is to equilibrate risk. So they say you want to have a parity of risk in the portfolio. And to do this, you lever up the bonds. You get more bonds having financed the increment with borrowed money. And that increment of bonds is going to equilibrate risk with equities, the stocks. All right, that's the theory. Now, that may work in a gently trending market. It has not worked at certain times and junctures in which both stocks and bonds decline together. So my sense is that there's a lot of money in risk parity, and that a forceful rise in interest rates, a steep decline in bond prices is going to force liquidation of some part of the risk parity portfolios. Now, Eric, you wonder how far it can go. People, I think, are arguing that it would be inexpedient if rates went a lot higher. They say impossible. What they actually mean is inconvenient. I forget now exactly what the size of the interest expense on the public debt is, about a $400 billion number. The government is paying 2.2 or something on its debt. So doubling of yields to 4 something and a doubling of gross interest expense to 800 billion or so would certainly be an inconvenience. It would require very painful political choices. But note, it is not impossible. So I think that, the stock market's going to run into trouble. It's richly valued. But I don't look for Armageddon. I look for higher rates. I look for appropriately lower price earnings multiples. And I look for a much higher interest bill on the part of the U.S. Treasury.
Now, one of the staple theories of macroeconomics is that supposedly as Treasury yields go up, especially relative to what sovereigns in other countries are offering, that attracts international capital and the currency appreciates at the same time. We're seeing this backing up in rates coincident with weakness in the U.S. dollar index. Normally, that's emerging market stuff. It's not supposed to happen in developed economies. What's the explanation for that, and can it continue?
Well, it can certainly continue. Things do. I don't know. I guess that people would perhaps be looking at real rates of interest rather than nominal ones. They would be saying, perhaps the learned people in the bond market are saying that, let's see, over the past 50 years, the average real interest rate, average real yield on the 10-year U.S. Treasury is on the order of, 2 point something or other, say 2.1% or so, I think. Nowadays, if the rate of inflation is 2, call it, and the yield on the 10-year is approximately 2.9%. That's less than 1 percentage point of real yield. Now that's before tax. It's not exactly a king's ransom. So perhaps people are saying, yes, nominal rates have risen. They may rise some more, but it's not such a great bargain. On the contrary, one might say, well, to be sure, it's not a bargain, but look in Europe where rates are considerably lower, and the creditworthiness of some of the sovereign issues is considerably more dubious. So, Eric, I do not have an explanation why the Treasury is out of favor with the world's bond speculators. It has happened before. Perhaps they, perhaps they read Twitter. All sorts of reasons.
One of the things that your answer brought to mind, you mentioned, this might be about real rates versus nominal rates. For several years now, deflation has been the backdrop, and everybody says, nothing else is possible. It's almost as if people have forgotten that inflation is a real phenomenon. Is it coming back? Is it on the horizon? Is it nearby? Or are we still likely to see continuing deflationary pressure in the economy for the next, year or two?
Well, Eric, I happen to be in the inflation camp. I'm most humbly placed there. There are powerful arguments on both sides of the question. But, something to bear in mind is that nobody issues a press release at the start of an inflationary cycle. It kind of creeps in on little cat's feet. 1960s, case in point, in the early 60s, there were 4 consecutive years. 1961 to 62, 63, early 64. In those years, the measured rate of inflation, the CPI, was, if memory serves, less than 2%. In fact, in some years, it was less than 1%. Parenthetically, nobody thought that was a problem. That seemed like a good thing. But it was the high noon of Keynesian fine-tuning, and the economists thought they had the system figured out. There was a great sense of triumphalism in the councils of the president's economic advisory committees. But then, lo and behold, comes what? Comes the Vietnam War, comes the demographic, comes the coming of age of the baby boomers, comes all sorts of things which in retrospect appear to have been instigators of a price inflation, but they were not so regarded at the time. But what had been a period of utter quiescence in prices suddenly became a period of creeping inflation. In fact, that creeping inflation had crept in the 50s and early 60s. Some people decried even a 1 or 2% inflation rate, but by the mid-60s, inflation was running at 3 and 4%, and we were launched on the 70s. What relevance does this have today? Well, the relevance is that you really don't know. So when I think about inflation, I think mostly about the risk-reward proposition of the bond market. We can't really predict these big cosmic cycles. We can observe what is in front of us and how people are positioning themselves. And what I observe is a lot of muscle memory, a lot of looking backwards, a lot of fitting the present-day news into the template of the Irving Fisher debt deflation model, of the fussing over the weight of encumbrance on the world's economies. I'm in the inflation camp. I think it's coming. I have thought this for a while. People have looked all over for it as if, looking for a lost sock or a hairpin. Okay, where did it go? Where is that thing? But I do believe that the central bankers who have been kind of begging for inflation will be surprised at the generosity of the inflation gods, what they'll ultimately be handed.
Now, you are in the inflation camp, which under normal circumstances would probably make you bullish on gold. But at the same time, you've said that this dollar weakness trend could easily continue, which would normally be bearish gold. Where does that leave you? Is it time to wait for the dollar to play out, or is this a good time to be buying gold?
Well, by way of confession and truth to podcasts, I confessed I was born in 1946. That makes me, like 37, right? Okay, I was born in 1946, and I was bullish on gold in 1945. I hope that puts my view on this into context. Chronically, sometimes profitably, but certainly very nearly continuously well disposed to the legacy monetary asset. I think that so many arrows point to it in the present day. I think it is the beneficiary will become the beneficiary, as I'm talking about gold now. Gold will become the beneficiary of so many trends, from the tinkering and the unprecedented experimentation of our central bankers, fiscal profligacy. I'm starting to sound moralistic, but I think that paper money is in a secular bear market, and that the institution of managed currencies will be seen to be a species of pretense, if not outright intellectual fraud. I use that word advisedly. And I think come the dropping of the scales from the eyes of the money holders of the world, gold will do better against almost every currency.
I want to come back to something you said earlier where you described if Treasury yields were to double, that would obviously double the government's cost of debt service. And, the cost of debt service was about the same as it is now 10 years ago, but there was half as much debt. So with twice as much debt, if we go back to 10-year ago Treasury yields, we double the cost. It surprises me, Jim. I get a lot of guests on this program who just say, oh, don't worry about it. They can always print more money. The U.S. government borrows in its own currency, so it's not a problem. I just don't understand that view, because it seems to me if that were to happen, sure, they could go to outright monetizations, fire up the printing presses and use it to service the debt. That presumably would have, an effect on markets that would be reflexive and cause people to maybe panic. So what do you think it would look like? Let's suppose that rates continue to back up and we move towards that doubling over the next few years of Treasury rates. That presumably creates a budget crisis for the U.S. government. What options do they have in order to respond to something like that, and how would you see it playing out?
It's one of these problems that will confront us when it confronts us. I'm not spending much time thinking about that now. I would contest a little bit, Eric, the idea that we have not been monetizing the debt. The Fed, of course, has been monetized. It is buying federal securities with credit that did not exist before the Fed tapped the relevant numbers on its computer keypad. The Fed has come to own substantial portions both of mortgage-backed securities and of Treasury securities outstanding. So that is, by definition, that is monetization. It has turned those pieces of paper or those digital images into living credit.
That brings me to another question, which is I've thought quite a lot about this. People don't seem to question that U.S. Treasuries are just always the safest possible investment on earth. Why they've always thought that and favored them over gold has always been a mystery to me. But frankly, it seems to me like at some point, I don't know what the point is, but you have to reach a level of debt where at some point it becomes impossible to ever repay that debt in real terms. You could always repay it in nominal terms because you can print more money. But If you get to the point where it cannot be repaid in real terms, where it becomes a guarantee when you buy a U.S. Treasury bond that you'll never get your purchasing power back, you may get positive yield in nominal terms, but you're always going to get a negative yield in real terms because the debt has gotten to such a level that they can't possibly service it in real terms. Doesn't that eventually lead to some aha moment where the market says, hey, wait a minute, the whole argument against gold and in favor of treasuries was gold doesn't return anything. Gold doesn't lose anything either. It doesn't have a negative real yield.
Eric, you have just described the 60s and the 70s and the early 80s. A moment ago, you observed that some people feel that treasuries are inherently safe. I would say that there ain't no inherent in any asset class. It's all a question of price and value. If you go back to the late 60s into the 70s, into the 80s, ending in about 1985, 86, what you find is the very commonly held view that treasuries are inherently unsafe. Leon Cooperman, I think, was the fellow who coined the slogan that treasuries are certificates of confiscation. That is to say, they guaranteed you a loss. Now, this was at a time when the inflation rate was running close to double digits, and treasury yields were not so much higher than those double digits. So everything you asked about with respect to a crisis of the future has in fact occurred in the past, and it was resolved with these difficulties. They were resolved by a fellow named Paul Adolf Volcker, who by constricting the growth in bank reserves of bonds, which ended on the 30th day of September 1981, when the Treasury 30-year bond touched intraday 15%. That was how that cycle ended. It didn't end all at once. There were retests of those lows in prices and highs in yield. But we got through it surprisingly well. So, this next cycle is not going to be identical to the last. I don't think that there is anything like Armageddon ahead of us. I think there is a realization that the monetary regime of the past 4 or 5 decades is wanting both an intellectual rigor, and it will be seen it's lacking in operational success. It's not seen now. So I think that, yes, there will be an aha moment. People say, can't we do better? And I think we will do better. But for now, people are mainly unquestioning about our system of currencies. They mainly don't think to ask what money is. Bond is a promise to pay money, right? And what is money? What is money? Years ago, when QE just started, there was a letter to the editor of the Financial Times, and the author of this letter said, at long last, I have now understood the meaning of the term quantitative easing. I now understand that. What I no longer understand is the meaning of the word money. And I so love that letter, and I so have been waiting for others to raise that very question. But the question still is mostly tabled. It is unasked. And I think that what you are asking, Eric, is when will a proper quorum of investors ask the question, what is money? And to that question, I say, I haven't got a clue.
Now, this massive, massive accumulation of debt in the United States, people like you and I can say this is crazy, the rate that it's happening at. But holy cow, look at China. I mean, they're in a whole different category of rate of accumulation of national debt. It seems to me like they're trying to almost race the United States to who can get more over-indebted faster.
No, they've won. They've won. There's no contest.
What can be the outcome of this massive credit expansion?
I'm going to describe it not in terms of national debt, but I'm going to describe it in terms of bank credit. So as of the end of 2017, Chinese commercial banks showed assets of $40 trillion. That's with a T as in Tom, $40 trillion. And that works out to about 50%, a little more than 50% of total world GDP. Now, for this, there is no precedent on Earth. More perspective, at the end of last year, U.S. commercial banking assets were about $17 trillion in the context of a $19 trillion U.S. economy. That's $17 trillion in commercial bank assets and a $19 trillion economy. Let's go back to China. $40 trillion on the bank's balance sheet, and the economy was something like $13 trillion in China. So this is a stupefying and astonishing literally a fantastic state of affairs in China. They have reinvented the sense of what's possible. I think it was 2016 maybe, the Chinese expanded banking assets by 16.5%. Now, if a single bank was expanding at that rate, you'd fear for its solvency because you would have a proper suspicion of the credit protocols of the lending officers. How can they lend that fast, and to whom, and to what end? But the Chinese have been growing at such breakneck speeds. So this debt has been in the service of all manner of infrastructure and real estate, and so the asset bubbles have been equally stupendous. You know, in the current issue of Grants, we have the headline is in the front page is Xi Jinping's poisoned chalice. This is the Xi Jinping, whose name I think I am butchering in pronunciation, is of course the new president for life. And our sense is that one-term presidencies in China are better than two terms, and that better than either would be emigration. So we think that Xi Jinping is the president for life in the wrong country. So it's just amazing what is happening in China, and I think that it represents a clear and present danger to everyone with money at risk, not just the Chinese, not just the real estate markets in favored countries favored by the Chinese, such as Australia, not just in the industrial metals markets. China has been kind of 100% of the demand for the margin for steel and the like. But this debt thing is a very, very important, low-hanging, dark cloud of the world, and we've all gotten used to it. God, we have at Grants, we've been decrying the Chinese lending and borrowing practices for years, with no real payoff yet. But we think now is not the time to accept it as normal. It ain't normal.
Jim, nothing lasts forever. 100 years ago, if you'd asked somebody, they would have said the British pound sterling is the world's reserve currency forever because it can never change. And of course, now they say it's the dollar forever. It will never change. It can't possibly be forever. Some people think that maybe the end of the dollar's regime as world reserve currency and having hegemony over the global financial system might maybe be starting to come to an end. China, of course, with their petro-yuan oil contract, seems to be trying to encourage oil trade to occur not in U.S. dollars. We see the petrodollar system in general starting to break down as Iran has outlawed U.S. dollars for exchange of their oil. Venezuela trying to move away from the dollar. Are these things really starting to point to maybe the end is close for the U.S. dollar? And if so, what would the consequences and knock-on effects be that investors should be thinking about?
Yeah, the dollar. Let us say, Eric, the dollar is the Coca-Cola of world monetary brands. And in its day, the British pound was the Earl Grey tea of monetary brands, well-entrenched. And there was no reason to suspect it would not be a perpetual favorite, the perpetual favorite. Lo and behold, the British Empire came into its sunset years, but observed that the pound remained an important reserve currency into the 1950s, notwithstanding the loss of British financial and military power. The U.S. dollar, it was on the outs in the 70s, and I remember people, including myself, speculating that the world was tiring of this reserve currency and that the dollar would be supplanted by something like gold. It was not supplanted. There perhaps ought not to be a reserve currency, but we do have one. It's the dollar, and I don't look for any quick change in that fact.
Jim, let's move on to junk bonds. Forgive my ignorance. Seems to me like the whole theory is junk bonds are worth less because you might not get paid back, yet European junk bond indices actually yielding less than U.S. Treasuries at one point. And I think you recently had written something about particular issues in Europe. How is this even possible that junk bonds are being bid up in price to be supposedly safer than U.S. Treasuries? How could that be?
Well, I think the answer to that question takes the form of two words, Mario Draghi. There is a very strong bid in Europe from the European Central Bank for securities of all kinds. We at Grants have made a major a major financial discovery. We have discovered a junk bond in Europe, denominated in euros, of course, that has a zero handle. You've heard of junk bonds beginning with the number 2 and 3. Those seem very low indeed. But we have found one that begins with the number 0, and that is in a Telecom Italia. I think it's a 5 1/4 of 2022. But the yield to maturity, which is the same as the yield to worst, is like 0.8. Now that is not a high yield security. It's a strong junk rating, but still it's speculative grade, and it is priced to yield less than 1%. Now that is the ocular evidence, that is the visual manifestation of the destruction of price discovery in Europe. That is on the European Central Bank. I think it is one of the great scandals of the present day. Now, in response, I think that Mr. Draghi would say that he had to do this because it was that or the end of the euro. But my goodness, interest rates are the most, I say, as the editor of Grant's Interest Rate Observer, interest rates are the most important prices of capitalism. And prices are better discovered than administered, certainly better discovered than repressed. And the incidence of these abnormal, aberrant, and even funny yields in Europe is evidence of something gone very wrong indeed.
That begs a very important question in my mind, which is really what you're telling us is these yields are being repressed by a man who has a printing press and therefore is not subject to the limitations of normal mortals like you and me. Does that mean it's not time to short this stuff yet because, the bid could get even stronger? I can't imagine European junk bonds going negative yield. When do you short this
Wait, Eric.
Is it now?
Why not? One is 80 basis points away from it. A lot of corporate debt, maybe my information is not up to the minute, but a considerable segment of the corporate debt in Mario Draghi's portfolio was yielding just about nothing or less than nothing in nominal terms. So anything is possible in this regime of financial suppression, repression, or depression, wherever it is.
Does that mean the opportunity is ripe to short these things now, or does it mean that we need to wait until there is a change of policy in the ECB before it?
Oh, this is not my topic. I write about this stuff for a living. I've become quite reluctant to advise the professionals in speculation what they ought to do. It would seem as if the risk-reward proposition in front of a potential short seller of some euro-denominated securities is very favorable. The risk to the upside in price of a speculative grade security quoted at less than 1%, that risk would seem to be minimal. But I leave it to those who do it for a living to decide whether it's time.
Jim, I want to move back to what probably is the biggest question on everybody's mind, which is the really big cycles. As you said, maybe we're at the end of a 35-year bond bull market. What are the drivers of these long-term cycles, and what controls when you spend 10 years at one extreme or another before the rates start to move again, and what should we expect to see next?
Well, Eric, on historical form, when one of these bond cycles gets started, it just keeps going, and the rhyme and reason for it is apparent mostly in retrospect. It might help to anchor one's perceptions of current-day interest rates with a little bit of historical perspective. So there is a page-turner of a book called The History of Interest Rates, and no doubt you have one by your bedside. And I called up the still living co-author of it, Dick Silla, who was a professor of financial history at NYU. And I said, Richard, I have read many but not every page of your magnificent narrative. Tell me, in the 5,000-year recorded history of interest rates, have there ever before been substantially negative nominal bond yields, not treasury bill yields, mind you, but bond yields? And Dick thought for a second. He said, no. So 5,000 year first. This was as of what? In July of 2016, I think there was something like $11 trillion worth of sovereign debt priced to yield less than nothing. All right. So there was a paper that came out of the Bank of England a couple of months ago, and very important, to me at least, observation, which was that as of early July 2016, the 10-year Treasury, quoted as it was at 1.2 1.36 or something at the low. This was the lowest reading ever recorded on a global benchmark sovereign 10-ish year yield. And that goes back to the 1300s. So we are looking at a truly epical low in the summer of 2016. Now, this is not to say that it definitively will prove to be the low. I think it will be. But we are looking at coming off a low that was literally unprecedented. And perhaps that extreme will help to set expectations for what may follow. And the reciprocal extreme in the previous bear market was likewise just so off the charts. I mean, 15% on a 30-year, 25-year non-call security. It was 14%, I guess, as recently as 1984. Those were such extreme yields to the upside. So we can look and say, they are going to be followed by reciprocally ridiculous low yield to the downside, and so they were. But we have never seen the likes of what we saw in the summer of 2016. And I think, again, one doesn't know, but I think this will be the backdrop for a very long cycle in rates to the upside.
Jim, as you think about potentially that big trend that is moving in the other direction from what we're used to, where are the opportunities or where are the places that investors and speculators should be looking? Is it at the outright trades, shorting bonds, or is it more opportune to be looking at spreads, curve flatteners and steepeners and that sort of thing? Is it outright trades? Is it pairs trades, looking at one bond class relative to another, say junk versus treasury, or where do you think the people should be looking in order to identify trading opportunities?
Eric, so what do you do when rates rise? Well, there are money market instruments, the humblest of the humble. Warren Buffett seems to be a reluctant participant in the treasury bill market to the tune of, $100 billion or so. You could do even better than treasury bills if you were willing to take some credit risk, and we at Grants have written about so-called cushion bonds, which are relatively high-yielding corporate securities trading near their call prices, offering yields of 3.5, 4, 5, and up. The trade-off is some, we think, manageable credit risk in return for an increment of interest income. And for some people who need that extra income, we have been looking at these corporate cushion bonds. But perhaps, Eric, another good place to look is in the alternative legacy monetary asset gold, which is utterly in the shade owing to the popularity of cryptocurrencies, owing to the popularity of stocks and bonds. Mining stocks are orphaned. Gold itself is very much a laggard. You'd expect that with the dollar weakening and with the world giving the stink eye to the U.S. Treasury, that maybe, just maybe, they would be looking for a monetary substitute for the dollar. They have not yet. We think they will. So, I'm playing what I suspect the readers of Grants have come to see as my monetary trombone, talking once again about gold mining shares and gold. I am discouraged but determined in my bullishness. I believe that gold will carve out a place for itself in the monetary realm once people begin to question the doctrines and the competence and the judgment of our central bankers, which I expect to happen about 15 years ago. So, but they ought to question it, and I expect they will.
Now, I want to ask you about what should be done as opposed to what is being done in terms of government policy. But before we get to that question, I want to touch on a book that you wrote called The Forgotten Depression, regarding the Depression of 1920-21. The Fed at that point was about 7 years old. Newsflash, they did not conjure $4 trillion out of thin air. In fact, they did almost nothing. How did that work out?
Well, the Depression of 1920-21 was a brutal one. Macroeconomic data were not so available then, so we can't exactly measure it as we do measure things now, but unemployment was certainly in the teens. There was a vicious liquidation of stocks and bonds. Bond prices fell. As stock prices fell, the real rate of interest on money market instruments was certainly in the teens. And what the Fed did, as you say, was approximately nothing. It indeed was a willing accomplice to this liquidation, to the deflation of those 2 or 3 years. The Treasury, for its part, ran a budget surplus. And the consequence of these policies was to, I think, to foreshorten the Depression rather than to extend it. In any case, what was a very, very difficult period came to an end, unlike the Depression of the 30s, which lingered really into the Second World War. And the conclusion of the book, as I described in this depression, is the final governmentally unmedicated business cycle downturn of our times. It was the last one which government did not actively intervene to suppress interest rates to do what they have now customarily done. And, you know, I think the evidence is in the historical record. The Depression was tough. It was, for many people, devastating, but it ended in a timely fashion, and the recovery took the form of the proverbially roaring 20s. I wrote it as kind of an advertisement for the price mechanism, for which I have the highest regard. And I'm sad to say that the price mechanism is rather on its back foot these days. But certainly it has served us well throughout history.
And so the effective conclusion is that the price we've paid for intervention is that, you know, it's 10 years later and it's still not clear that we've really recovered from anything. I want to consider, though, obviously, you've explained in this interview and in much more detail in the book, which I highly recommend, The Forgotten Depression. You've explained that you think it might have been better had the Fed not gotten itself into the business of fixing the price of the world's most important commodity, which is money itself, through interest rates. But I want to frame the question differently. Considering that what has happened, here we are, $4 trillion Fed balance sheet. Now that we're here and the mistakes that have been made, I know you've said you don't want the job that Jay Powell has, but if you were forced into it, if you had to do it, what would you prescribe? What should the government be doing to get us out of the pickle that they've gotten us into?
Well, if the stipulation is that you have to work within the system as it has come to be, which is a fair thing to propose to somebody. If you had to manage the system we have rather than to conceive and to implement a new one, how would you do it? And what I would try to do is I would say, look, the government is no more in the business of rigging markets. We're out of that business as of now. If the stock market wants to go down, it shall go down. We're not in the business of stimulating asset prices to goose consumption. We are no longer in the business, by the way, of propping up banks. We are going to try to give you a currency that is stable in its purchasing power, and we are not going to implement a 2% rate of rise in inflation. We are believers in no inflation. So what you will hear from us from now on is less. We are not in the micromanagement business. We are not indeed, the macroeconomic management business. We are about a stable dollar. That's it.
Jim, before we close, my favorite scene in the movie The Big Short is where they have this very elaborate made-for-Hollywood scene. These guys are supposedly in the waiting room of a bank, and they find somebody else's pitch book and discover the opportunity to short subprime. At the end of the scene, the actor looks in the camera and says, okay, we did this for the movie, guys. If you want to know the real truth, I learned about this opportunity by reading Grant's Interest Rate Observer, and I cracked up.
That was my favorite part of the movie, too. It's amazing. What a coincidence.
I thought it was great. Needless to say, I think almost all of our listeners are already familiar with the publication. It's one of the most famous publications on Wall Street. You had Jim Rogers as your first subscriber.
He was your first podcast guest, too, right?
He was my first podcast guest and your first newsletter subscriber. We share that in common. I hope Jim is listening. Jeff Gundlach has described it. Of course, Jeff is the head of Double Line, one of the biggest bond guys in the country, in the world. world has described it as the only investment research that he actually pays for. Before we move on, because we have to pay for it too, but Patrick's actually worked out an incredible deal with your office. Tell us a little bit about the publication, what it's about for anybody who may actually not be familiar with it already.
Grants is a twice-monthly publication. It deals with a whole variety of things. It's quite opportunistic in its journalism, as a good hedge fund is opportunistic in seeking out value. We look for the best and the worst. We look for the best values in the long side, and we look for the worst candidates when we're pitching a short. We are about stocks and bonds and gold and good writing. That's what we're about. And we've been doing this for not quite, but almost 35 years. And you got to read it, Eric. I appreciate that question. It's a great question to be asked, of course, and I appreciate the great question. And I am grateful indeed for the time you have given me to talk about my favorite things, which are the financial
Cryptocurrency News Channel. Your new future. Thank you. Follow us on YouTube.